Welcome to the sixth video in this series, aimed to assist business owners and managers to better understand and manage the finances of their business. The intention of this sixth session is to provide a better awareness of the basic principles of accounting. Whether you look after the accounts yourself or have somebody who does it for you, it's still useful to have an awareness of what is going on. We'll achieve this by going through some typical accounting transactions and seeing how they affect a set of accounts. Generally, we'd be using an Excel model for this purpose. So let's have a quick look at this Excel model and view the two main reports that you will normally get from your accounts: the profit and loss report and the balance sheet. If we look at what we call the trial balance, you'll see that this is made up of a series of accounts, including the bank account, overheads, turnover, direct costs, and so on. This is basically how any accounting software or accounting package will work. It will sort your accounting transactions into various different pots or accounts so that the information coming out of your accounts package will be meaningful for you. So let's go back to the start of all companies. There'll be an owner or owners, and to get the company going, they are more likely than not to give that company some money so that the company can open a bank account, put the money in, and start trading. Having done that, it's fairly obvious that as far as any company is concerned, it's owed money by the bank. And as far as the owner is concerned, they're owed money by the company. Now, this training session is all about the company accounts. So let's consider how this is reflected in our account model. Let's assume that the owner of the company decides to start the business off by giving the company £10,000, which the company will then deposit into the bank. So let's find the bank account. Now, bear in mind, this bank account is the bank account within the accounting system of the company. And as far as the company is concerned, the money that is in the bank is now owed to it. So if this happened on the first day of this year, the company will record the fact that it's owed £10,000 by the bank, and that debtor is recorded as a debit. You'll of course be aware that when the bank sends a bank statement to the company, it will reflect the company as being in credit. That's exactly correct, because that's the bank saying that from its point of view, the company is a creditor. In other words, the bank owes the company the £10,000. From the company's point of view, the bank is a debtor, and that's why it reflects this as a debit within its accounting systems. Now, if we look at the balance sheet, we see that £10,000 is being correctly recorded. The name balance sheet implies that the top and bottom should balance, and at the moment, that's clearly not the case. This illustrates an absolute principle of accounting, and that is double entry. Each time we record a transaction, it must be recorded in two accounts. All we've done so far is record it in the bank account. Now, the owner may well want to record part of that sum of money as a loan, but for the purpose of this illustration, we'll assume the company issues shares to the value of £10,000 to the owner. We now need to record that fact, so we find the shares account, and on the same day, we record this initial investment. With double entry, it's always equal and opposite. The money recorded in the company's bank account was a debit, therefore the money recorded in the shares account has to be a credit. Now, after doing that very simple first transaction, we find that the balance sheet now balances. The bottom half of the balance sheet tells us what the owner has put in, the £10,000, and the top half of the balance sheet tells us where that money is. And it's in the bank account, which we have called cash. Finally, for this first transaction, let's check the other main accounting schedule, the profit and loss account. As you see, there's absolutely nothing in the profit and loss account, and this is correct because so far, the company hasn't commenced trading. So we now have a company with £10,000 in the bank. Let's use that money to buy some equipment for £5,000, some raw materials for £2,000, and let's bring in some contract labour for £1,000 to convert the raw materials using our equipment into finished goods. So what's that going to look like in our accounts? Let's assume that all our purchases are cash. Therefore, let's see if we can find our bank account so we can record those purchases in our accounting system. It doesn't really matter what date we put in here. For our purposes, let's just select the first of the second month, and we said we bought some equipment for £5,000. It follows that if money into the bank is a debit, then money out of the bank is a credit. We also said we'd buy some raw materials for £2,000, and finally, we said we'd bring in some contract labour and pay them £1,000 to convert our raw materials into finished goods. You'll notice that we now have an unbalanced balance sheet again. That's because we've simply recorded the payment of these items, but not carried out our double entry. So now let's do the double entries for all of these items. First of all, the equipment that is going to be with us after we've done our processing, so let's put that into assets. Payment out of the bank was a credit, so the double entry into our asset account has got to be a debit, and this was the £5,000. Our raw materials initially will go into stock, and that was a payment of £2,000. Again, the double entry is a debit because the money out of the bank was a credit. Let's think about the labour for a moment. What that labour has actually done is added value to those raw materials. So it's added value to our stock. So the labour will also be charged through to stock, and that was £1,000. For now, we see that we have a balance sheet that balances again. Let's just recap on the meaning of that balance sheet. The bottom half still shows what the owner has put into the company, which is the £10,000. That £10,000 is now represented in the upper half of the balance sheet by fixed assets of £5,000, stock to the value of £3,000, and £2,000 remaining in the bank account, adding up to the £10,000. We also now have some finished goods that we can sell. Let's say that we agree a price for half of the goods for £2,500. So we sell 50% of our finished goods, dispatch them, and then we raise an invoice to the customer for £2,500. We'll now record the sale in our accounting system. But just before we do, note again that the profit and loss report is blank. This is because up to this point we haven't recorded any trading, and the balance sheet, of course, as we left it, is now balanced. The sale that we have made is not for cash, so we need to find our debtors account and again choose a date fairly randomly, and we'll put into the description the fact that we have sold 50% of our stock. We'll record the value that we agreed the invoice was for, £2,500, and the customer, until they settle the account, is a debtor of the company. Therefore, it's a debit entry into the debtor's account. That's one side of the entry, and as you'll see from the balance sheet, it's indicating that again we need a double entry. It's a sale that we've just achieved, therefore we'll need to find our turnover or sales account, and on the same date we record the sale. Again, as it's a double entry, we created a debtor in the debtor's account, therefore on the sales or turnover account, that must be equal and opposite. It's therefore a £2,500 credit. We'll also actually choose a department. Don't worry too much about that for the time being, it's something that we'll come back to in later sessions. But we'll just choose Department 1 to record the sale against. Looking at the balance sheet, you'll now see that it remains balanced because we've done our double entry. We'll also have a look at profit and loss report, and here you'll see it's recording the sale of £2,500. At the moment, it's showing the sale all the way down to the bottom as profit before tax. And needless to say, it's not all profit because we now have reduced our stock level by 50%, and we must also recognise that in our accounts. We'll therefore look for our stock account, and we record there the fact that we have sold 50% of that stock. So what we have done is reduce the value of our stock by half, and to do that we must credit it by half the value. This being £1,500, leaving a stock value that you can see at the bottom here of £1,500. This again is only half of the entry. We need to carry out the double entry, and to do this we'll find some more accounts. So we'll find the direct costs account. We'll continue to use the department that we chose, and here we'll record the cost of the sale, the materials that were within what we've sold, And if you recall, we initially paid £2,000 for the raw materials, then put them into stock. We've now sold 50% of the stock. Therefore, we record that half of the raw materials have now been sold, and half of the raw materials will be worth £1,000. We'll then go to the labour account, and there we'll record that again against Department 1, we've sold 50% of our stock, and the labour content of that stock we initially paid £1,000 for. So the labour content of half of the stock must be £500. Now if we look at the balance sheet, we've now completed our double entry. You'll note a variation that there was one entry on the credit side and two entries on the debit side. As long as they add up to the same amount, that's fine. The balance sheet now is telling us something slightly different, but let's first of all look at the profit and loss account. This is recording our sale of £2,500, and it's recording the fact that the sale had an inherent cost or value being half of the stock, broken down as materials and labour, and having a cost of £1,500, giving us a gross contribution on that sale of £1,000. Now, if you look at the balance sheet and the bottom half, that gross contribution of £1,000 is being added to the investment made by the owner, because that profit is owned by the owner. It's their profit. So that bottom half of the balance sheet becomes £11,000. Equally, the top half of the balance sheet becomes £11,000, and that's represented by £5,000 of fixed assets, the £1,500 remaining in stock, the £2,500 that is owed by our customer, and the £2,000 that remains in the bank. We referred to gross contribution when we were looking at the profit and loss account. That's a contribution to our profit, but we do have the costs, those direct costs that are there whether your company is producing and selling or not. Costs such as rent and rates, the cost of your backroom staff, insurances, your IT costs, and so on. In other words, your overheads. Let's put some overheads through the accounts package so that we complete the exercise. Let's just record the fact we've paid £200 for some office staff, and that maybe we've paid £100 for some IT costs. First of all, let's find our bank account again. And we'll say that on the 1st of the 4th, we paid £200 for some office staff, and we received a bill in from our IT provider for their services, and that bill was for £100. You'll notice that I'm not putting that £100 in the bank account because we haven't yet paid the bill from the IT services company. But the money out of the bank would have been a credit, and therefore we are recording that we have a creditor. In other words, somebody we must eventually pay £100 to. Again, those are one-sided entries, so we need to put the double entry in, and there's another account here for overheads. So in there, we will record the fact that we have paid office staff £200, and that we've received an invoice from our IT company for £100. Both of those are debits, they are charges to overheads. So if we now look at the P&L account, we see that it's becoming a little bit more realistic. We sold half of our stock for £2,500. The value of the stock sold was £1,500, giving us a gross contribution of £1,000, less our admin expenses of £300. And we've made an actual profit of £700. That's now reflected in the balance sheet. It records on the bottom half the value of the initial investment made by the owner, and then the profit made to date, which also belongs to the owner. This is reflected as £10,700 in the bottom half, and the £10,700 in the top half is represented by £5,000 worth of fixed assets, £1,500 worth of stock, £2,500 of debtors, £1,800 left in cash at the bank, and a creditor of £100, giving the net amount of £10,700. In going through those simple transactions, I hope you've gained a better understanding of what goes on behind the scenes, as it were, in your accounts software package, and also that you've gained a better understanding of what's in your profit and loss account and what's in your balance sheet. Just to check your understanding, let's consider one or two simple questions. If you're unsure, you can always replay certain parts of this video. The first question, and one of the most essential things to understand, is if you put money in the bank on behalf of the company, is that a debit or a credit in the books of the company? This will be a debit in the books of the company, and it will appear as a credit on the bank statement received from the bank. The second question, is a sale a debit or a credit? Consider the fact that when you eventually get paid for the sale, that will be money into your bank, which is a debit. Therefore, the sale has got to be equal and opposite. It follows, therefore, that a sale is a credit in your books or accounts. Our third question. If you buy stock on behalf of the company, does this affect the profit and loss accounts of the company? The answer here is no. Buying stock does not affect your profit and loss account, as it will remain in your stock account in the balance sheet until such time as it's sold. When that element is sold, it will be transferred into the cost of sales, which will affect your profit and loss account at that point. Question 4. Which of the two main schedules shows the worth of the owner's investment? Is that the profit and loss account, or is it the balance sheet? At any given point, assuming all your accounts transactions are up to date, the balance sheet will show the current worth of the owner's investment. In the bottom half of the balance sheet, you'll have the original investment, plus, or indeed minus if there is a loss, but plus the profit made to date. The top half of the balance sheet will show where that value is amongst the fixed assets, the current assets, and the current liabilities.
Finally, here's a reminder of the other videos and resources you can access to help you understand and manage the finances of your business.